Imagine this. You're, say, a business leader looking to expand into exciting new markets, maybe Oman. Or perhaps you're just an individual. You've got investments spread across borders, you've done your homework, your strategy's all set, finances aligned. And then, wham, the tax rules change. How on earth do you keep up with these international agreements that can, really hit your bottom line? Well, welcome to the deep dive. Today, we're unpacking a really crucial development in international tax law. It's the new protocol amending the Double Taxation Avoidance Agreement, the DTAA, between India and Oman. Our source material for this is the official notification from India's Central Board of Direct Taxes, the CBDT. It came out June 25th, 2025, and it details all these changes. So our mission today is simple. Dig into this legal doc, pull out the key insights, and help you understand what this updated agreement means, especially how it tackles tax evasion. Okay, let's unpack this.
Yeah, and to really get why this amendment is such a big deal, it helps to remember why DTAAs exist in the first place. They're there mainly to stop income being taxed twice, right? Once in each country. And also, importantly, to boost economic ties. The original India-Oman one, for context, it's been around a while, signed back in 97. April 2nd, 1997.
Okay, so if we had one since 97, why the update now? What needed fixing after, nearly 30 years?
That's a fair question.
Yeah.
Look, these agreements, they can't just sit there unchanged. They have to evolve. Business changes, think digital economy, new global tax challenges. It just means older agreements need refreshing to stay relevant and, crucially, to fight off newer, maybe more sophisticated ways of avoiding tax. So this protocol, it was signed in Muscat, January 27, 2025, and it officially entered into force May 28, 2025. That's when both countries confirmed, all the legal hoops were jumped through.
Right. And the key question for listeners, when do these changes actually start showing up on, say, tax returns?
Good point. For India, it affects income earned in any fiscal year starting on or after April 1st following that entry to force date. So that means the fiscal year starting April 1st, 2026. In Oman, it's for income in any tax year after the protocol entered into force, so sooner there. But what's really fascinating here, and it's a big signal, is the preamble. The wording at the very start of the agreement, Article 1 of the protocol spells this out. It now explicitly says the goal is eliminating double tax without creating loopholes. No non-taxation, no reduced tax through evasion or avoidance, and it specifically calls out treaty shopping arrangements aimed at getting benefits for residents of third countries.
Wow, okay. So that preamble isn't just fluff. It's a real statement of intent, putting that anti-abuse focus right up front. How significant is that, having it spelled out so clearly at the start?
Oh, it's hugely significant. It really sets the stage for everything else. It signals this fundamental shift, right? It's not just about avoiding double tax anymore. It's actively about preventing misuse of the treaty. And treaty shopping, just to clarify for listeners, that's when someone, maybe a company, tries to route income through another country just because that country has a better tax deal with India or Oman.
Ah, okay.
This new preamble basically says, nope, we're wise to that.
Got it. So with that strong anti-abuse message framing everything, let's get into the nitty-gritty. Some concrete changes. What about basic definitions like taxes covered or competent authorities? Anything notable there?
Yeah, a couple of useful clarifications. Article 2 for Oman, it now simply says the income tax or Omani tax, just cleaner terminology. And Article 3 clearly names the competent authorities. For India, finance minister or their rep. For Oman, chairman of the tax authority or their rep. Makes it very clear who's in charge of making this work day to day.
Okay, simple enough. Now, this next one sounds interesting, Article 4, dealing with dual residency for companies. If a company is technically resident in both India and Oman, how is that decided now? I gather the old way might have been clearer.
It's definitely a big shift. Previously, there might have been a more automatic tiebreaker rule. Now, if a company, a non-individual, is resident in both places, the competent authorities, so those officials we just mentioned, they have to try and determine residency by mutual agreement.
Okay, mutual agreement. What do they look at?
Key things are the company's place of effective management, basically, where the real decisions get made, also where it's incorporated, and any other relevant factors. It's a bit more holistic, maybe.
And what if they can't agree? That sounds like it could happen.
Right, and this is the crucial bit. If there's no agreement, the company won't get any relief or exemption under the DTAA, full stop, unless the authorities agree on some specific limited relief anyway.
Wow. So no agreement means potentially double tax, or at least no treaty benefits. That really raises the stakes for companies straddling both countries.
Exactly. It forces much more upfront thinking about where your company is really managed and controlled. You can't just rely on, say, incorporation location if the management reality is different. It changes the structuring game.
So that startup founder may be registered in Oman for, I don't know, lower taxes, but actually running everything from Mumbai. They might suddenly find things much more complicated.
Precisely. The onus is now squarely on them to show where the substance is, and maybe even talk to the tax authorities proactively.
Okay, let's switch gears to something with a very direct financial impact. Royalties and technical fees. Articles 7 and 8. I hear there's good news here for some.
Yes, this is where it gets quite interesting for businesses involved in cross-border services or tech licensing. It's a direct financial benefit. The withholding tax rate, that's the tax deducted at source when paying these fees across borders, it's been cut.
Okay, from what to what?
Previously, it was 15% for both royalties under Article 7 and fees for technical services under Article 8. Now, it's down to 10%.
10%, that's a pretty significant drop. A third off.
It is. That directly helps cash flow and makes those kinds of cross-border deals between India and Oman, more financially attractive. Technology transfer, services. It should encourage that.
Makes sense. And sticking with companies, what about associated enterprises? Article 6 adds something to Article 10 of the main agreement related to transfer pricing adjustments. What's that about?
Right, transfer pricing. This new bit, paragraph 2 in Article 10, tackles a specific problem: economic double taxation. Imagine an Indian company sells something to its Omani subsidiary. India's tax authority thinks the price was too low, artificially shifting profit to Oman. So India adjusts the profit upwards and taxes it.
Okay.
But Oman might have already taxed the profit based on the original lower price. So the same profit chunk gets taxed twice within the group.
Ah, I see the problem. So what does this new paragraph do?
It says if one country makes such an adjustment, the other country shall make an appropriate adjustment downwards to the tax it charged on that same profit. It ensures the group isn't taxed twice on the same income just because of a transfer pricing dispute.
Right, so it forces coordination between the tax authorities to avoid that double hit. Seems fair.
Exactly. It aligns with international standards on handling these adjustments.
Okay, so the overall theme seems to be clearer rules, some rate cuts, but also much tighter controls. Let's really lean into the enforcement side now. Article 10 brings in a whole new Article 25A on non-discrimination. Why was this needed? What does it cover?
Yeah, this is a brand new article, and it's pretty comprehensive. It's about ensuring fair treatment. Key points are: nationals of one country shouldn't face heavier taxes in the other than that country's own nationals in similar situations. Permanent establishments, like a branch of an Indian company in Oman, shouldn't be taxed less favorably than a local Omani company doing the same thing.
Makes sense.
Also, things like interest, royalties, technical fees paid to someone in the other country should generally be deductible for tax purposes under the same conditions as if paid locally.
Okay.
And finally, companies owned or controlled by residents of the other country shouldn't face extra burdensome taxes just because of that foreign ownership.
So, connecting this to the bigger picture, it's about creating a level playing field, making sure foreign businesses or individuals aren't penalized.
Precisely. It promotes fair competition and removes tax barriers based purely on nationality or ownership. It's about ensuring the tax system doesn't discourage legitimate cross-border activity.
Okay. And building on fairness, Article 11 revamps the Mutual Agreement Procedure, or MAP. That's the process for resolving disputes, right? The entire Article 26 is replaced. What was the big headache with the old MAP, and how does this new version help?
A major frustration, you hear this a lot, was often about delays and getting stuck. Cases could drag on, sometimes hitting domestic time limits for making adjustments. Now, taxpayers have a clear 3 years from the first notice of incorrect taxation to present their case. That's helpful.
3 years, okay.
But the really crucial change is this: any agreement that competent authorities reach must be implemented regardless of any time limits in the domestic laws of India or Oman.
Ah, so no more getting timed out by local rules.
Exactly. That provides much more certainty that if the authorities agree on a fix, it will actually happen. Plus, they can now communicate directly, which should speed things up too. Less formality, more direct problem solving.
That sounds like a practical improvement. Now, Article 12 tackles exchange of information, replacing the old Article 27. Tax authorities always want more information, especially across borders. How much further does this new article go? Is it really a game changer for finding hidden money?
Oh, absolutely. This is a significant expansion. The standard now is that authorities shall exchange information that is foreseeably relevant. That's a very broad standard.
Perceivably relevant for what?
For carrying out the DTAA itself, or for enforcing their domestic tax laws covering all kinds of taxes, not just those covered by the treaty.
All kinds. Wow.
Yes.
Yeah.
And crucially, look at what cannot be used as an excuse to refuse providing information. A country can't say, we don't need this info for our own taxes.
Okay.
They can't refuse just because the info is held by a bank or other financial institution or a nominee or someone acting as an agent or fiduciary.
So bank secrecy is basically gone for tax purposes between India and Oman.
Effectively, yes, in the context of information exchange requests under this article. And they also can't refuse just because the information relates to ownership interests in a person or entity. It removes major historical barriers. It's a powerful tool against offshore evasion.
That does sound like a game changer. Which leads us to Article 13, introducing another brand new Article 27A, Assistance in Collection of Taxes. One country helping another collect its tax debts.
That sounds intense. What are the implications?
Intense is a good word. It's a huge step. The two countries shall its mandatory lend assistance to each other in collecting revenue claims.
Revenue claims meaning?
Taxes of every kind and description, plus interest, penalties, collection costs, basically a whole amount owed. If a tax debt is officially enforceable in, say, India, Oman must accept it for collection, using its own collection powers as if it were an Omani tax debt.
So the Omani authorities could pursue someone in Oman for unpaid Indian taxes. Yes, and vice versa. It even extends to measures of conservancy, things like freezing assets, even before the tax debt is finalized, if needed to secure the claim.
Goodness. So hiding assets across the border just became much, much harder?
Drastically harder. It means your tax obligations really follow you. There's nowhere to hide just by crossing the border between India and Oman. It significantly raises the stakes for compliance.
Definitely closes loopholes. Okay, and finally, still under Article 13, we get another new one. Article 27B, Entitlement to Benefits. This is the Principal Purpose Test, the PPT. You hear a lot about PPTs globally. How does this change the game for tax planning?
This is arguably the capstone anti-avoidance measure. It's a general anti-abuse rule, or GAAR, embedded right in the treaty. It says, basically, you don't get a treaty benefit like that reduced withholding tax we talked about if it's reasonable to conclude that getting that benefit was one of the principal purposes of setting up the arrangement or transaction.
One of the principal purposes, not the sole purpose.
Exactly. That's key. It doesn't have to be the only reason, just one of the main reasons. The only way around it is if you can prove that granting the benefit in that specific situation would actually align with the object and purpose of the relevant treaty provisions.
So it forces you to look beyond the strict legal form of a transaction and ask, why are we really doing this? Is there a genuine commercial reason, or is it primarily about grabbing a tax benefit?
Precisely. It puts the focus squarely on economic substance and intent. It makes aggressive tax planning structures designed purely to exploit the treaty much riskier. It forces businesses to ensure their cross-border activities have real commercial logic, not just tax logic. It fundamentally rewrites the playbook.
Okay, let's try and wrap this up. So, summarizing this deep dive, we've seen the India-Oman DTAA get a major modernization. Clearer definitions, yes, some helpful rate cuts on royalties and technical fees. But the really big story seems to be the massive strengthening of anti-abuse measures. That explicit preamble, much wider information exchange, cross-border tax collection assistance, and this powerful principal purpose test.
That's a great summary. So what's the takeaway for you, the listener? If you operate, invest, or earn income between India and Oman, well, the landscape has changed. It's more transparent now, maybe more predictable in some ways, but definitely tougher on tax evasion and avoidance. It really highlights that global trend, countries working together much more closely on tax matters, making sure treaties are used as intended, not exploited.
Absolutely. And here's a final thought to leave you with. As you digest these changes, consider how these stronger cooperation tools, especially the assistance in collection and that overarching PPT, might influence more than just tax structures. How might they change the kind of due diligence companies and individuals do before even entering into cross-border deals? In a world that's increasingly connected, but also, it seems, increasingly scrutinized by tax authorities, something to mull over.